The title is, Are we about to face a global financial apocalypse? And if so, how can you protect your money and how can you profit from it? Because I created this webinar because, frankly, it's a question I've been asking myself and have been talking to a number of friends about for a couple of years now. And I think we need to face it head on. We've got a bond market that looks like a massive bubble, a stock market that's wobbling, a potential currency reset across the world with many countries, including ours, seriously developing central bank digital currencies. We have the possibility of Russia returning to the gold standard, which could be an interesting thing, rampant inflation in many countries, stagflation really in the UK, I would say, a housing bubble in this country and others, and on and on and on. It's looking like a perfect storm to me, but of course, every cloud has a silver lining. So even if things are looking problematic all over, and they are, I think, there are also opportunities. So I've got a few experts to help us look at different aspects of the global economy and the financial situation. Firstly, we have my friend Tim Price, co-founder of fund managers Price Value Partners. I'd ask him to wave, but it wouldn't make any difference.
I'm waving furiously, but no one can see me.
Yeah.
Yes, we believe you. We believe you, yes.
Overt waving.
Yeah, exactly. We have Cameron Parry, who's founder of Tally Money, a really interesting new savings product based on gold. Say hi, Cameron.
Hello, everyone.
Good. And we have Johnny Fry in Melbourne, Australia right now. It's just gone 5 o'clock in the morning for him. So thank you, Johnny. He's a former fund manager and more recently the founder of Team Blockchain. He's also a crypto specialist. Say hi.
Good morning. Or good evening.
Yes. And we have Adrian Lowery, former investment journalist for the Daily Mail and This Is Money, and now with the investing platform BestInvest. Hello, Adrian.
Hi, how you doing?
And we have you, lovely visitors, and we're looking forward to hearing from you too. So feel free to put questions in the chat box, or wave at us to say hello. And Izzy and I will pick them out and put them to the team for their comments. So let's get straight in. And I'm going to start with you, Tim, because you were first on the list. Do you think we are facing a global financial apocalypse? What's your take on things?
I mean, apocalypse is a strong word, but here I reveal my exquisite mastery of the various European and Middle Eastern languages. Apocalypse apparently in the original Greek means unmasking or unveiling, so it's not necessarily equivalent to Armageddon, but it merely suggests that we're going to pretty soon we're going to see who's who and what's what. And I think if you express the market in those terms, if you describe it in those terms, I think that's a fairly good analysis of synopsis of where we are. So just to very, very quickly sum up, because obviously there are plenty of other panelists who want to speak. My background is in the bond market. I was a bond salesman for 10 years before I moved into private client portfolio management. I've written 2 books about investing. One is freely available to anybody that would like to have a copy. I can send it a PDF copy via our website, pricevaluepartners.com. It's called The War on Cash, and that was one I wrote in 2015. And I was basically 7 years too early for that one. And the second is, I'm going to again give a free plug for it, so sorry to abuse your webinar for this. Investing Through the Looking Glass, which is effectively a follow-up that I did in 2016. What is common to both of those is that the real problems in the financial world all derive from the bond market. The fundamental problem is that the world is drowning in debt, government debt specifically, but to a lesser extent, corporate debt, household debt, mortgage debt, the works, but it's specifically a government debt problem. If anybody is wondering why we're seeing so much inflation, it's because the governments are deliberately creating it. Ludwig von Mises, who was one of the founders of the so-called Austrian school or classical economic school, made a very important point when he said, and this is someone who had first-hand experience of the Weimar hyperinflation in 1923, he said, inflation is not an act of God. It's not something that sort of just comes by surprise out of a clear blue sky. Inflation is a policy. The inflation we're now seeing is a direct central bank policy because the central banks acting on behalf of governments really basically want to destroy the value of that accumulated debt. And what better way of doing it than inflating it away? So I think all things ultimately can be tied back to the fortunes of the bond market. And as you've already highlighted, the bond market is in the course of exploding at the moment. So one thing I think the business of investing for anybody at the moment is actually relatively straightforward, because the main thing is just to know what not to hold. And I would suggest that one thing that you absolutely do not want to hold now is bonds. Discuss.
Yeah, yes, absolutely. Discuss. I think that's a really interesting one. And because Mike Child here has put a question here, evening, Mike. So are we looking at something comparable to the financial crisis of the late 2000s here? Or is this something different and or worse? Cameron, discuss.
Yeah, well, just so we've still got everyone with us after that introduction, Jasmine, it sounded like the world was coming to an end, and hopefully nobody's run off and,
I've just seen my next door neighbor hurtle past the window on the way down.
So I suppose philosophically, humans as a race and our societies are very resilient, and we adapt. And even if we're under, really bad conditions, or in whatever way, we do seem to be pretty resilient and come up with, a better way of doing things in future after we come out of the shadow of whatever happened in the past. After saying that, I'm trying to think, what was the specific bit you
well, yes,
we're repeating the end of the 2000s.
Yeah, yes. Is it same as the financial crisis, or is it worse? Is it different? What do you think?
The problem there, I suppose, in some ways, it's quite similar. In the sense, it's just magnified, because basically we were in a currency crisis caused by the massive amounts of debt, and to plug that hole, central banks decided to create much more debt at a multiple than what we had then, and we almost had our financial system grind to a halt at that point. That was actually what that's when I started paying attention to, I guess, what money was actually, and that was the first little acorn or whatever of what led on to designing Tally, which I'll be happy to plug later, seeing as Tim's already done it with his book, if we're allowed to do that.
Absolutely, you're allowed plugging here.
But yeah, I mean, basically, whether you're a household or a country, or, if you've got too much debt, eventually it'll consume you. If interest rates move, so they had some more levers and pulleys back then, and they could drop interest rates and, fuel all this quantitative easing. They're a bit stuffed now, central banks, because they don't tend to historically make very clever decisions, and quite harmful. And as Tim's pointing out quite rightly, that these are policy, these are premeditated sort of things that occur a lot, because they are, they're either, baked into the agenda of governments that effectively want to kind of need to overspend to win our popular vote, overpromise, overspend and all this. The Federal Reserve or the central bank, whichever one you've got, they are part of this mix, just to continue, and governments do this throughout history, continue to debase the population's currency. And that's why it's good to have it anchored or tied to something, because you've got something that you can understand the value of. So like, back in Roman times, if they had a gold coin or something, you understand that gold's valuable, and a coin's a nice uniform thing to use. But again, the problem with governments being in charge of the monetary system is that they continue to debase it. And all of a sudden, next year, you're using a coin that's only got 90% of gold, and the rest is a bit of an alloy. And this, because they overspend, and in a way, it's they overspend, they overpromise. So, but then again, we like that because we vote for who promises us good stuff, or more stuff maybe.
That is the problem, Cameron. And I'm thinking, as Mike Child here said, is it going to be the same as 2008, essentially, at the end of the noughties? Do you think it's going to be the same or worse? Because
I think they won't be able to buy themselves as much time. They just don't have the levers. This is where this whole monetary reset and monetary systems do seem to reset every, 30 or 50 years. And we've been going 50 years with fiat currency now since 71. I don't underestimate that it can go on for a few more years, because it seems like this can't go on much longer. But actually, I don't underestimate that it can go on for for another even maybe several years, half a decade or something.
Yeah.
But ultimately, you want a system that's not corruptible. So you want a protocol or a structure where you've got a money supply accountable to something other than somebody's arbitrary decision making to decrease the value of the money that we all hold. But a reset, even that still won't do it if you've got the same people in charge who at that point will say, well, we're the only ones experienced in all this now. So we should definitely be in charge, even though we, cocked it up for everyone last time. It'll.
Well, I'll come back to you because we'll talk about gold in a minute, but I'm going to ask Johnny because, as you say, we're talking about the end of fiat currency potentially. And so everybody understands fiat currency is the currency we use, dollars, pounds, euros. Fiat means a declaration, really. Yeah. And so our government says that's a pound, and we all go, oh, all right then. But so that's why it's called fiat currency. But Johnny, you know about cryptocurrency, and that grew out of the financial crisis. Do you think we are moving into cryptocurrency, or is it going to be something else? Cameron has a gold-backed product, and you've come across some others. What do you think is going to happen next?
Well, I think to answer the question, are we about to enter some sort of financial crisis? I think it's a little bit like someone's freedom fighter is someone else's terrorist. And will it be the same as it was in 2008, or will it be the same as 1992, or will it be the same as 1987 or 74? And so we can go on in terms of times. I think the one thing you can guarantee, no, it will not be like it was before, because the situations are different and the markets move, and they do have a degree of memory attached to them. So I would say what we're looking at is probably one of the greatest opportunities for investors, because now you have access to information in a way you never ever had before. And we're seeing a whole plethora of assets which were just not available. So as an example, talking to a company down here in Australia, where I am currently, for a flyback on Saturday, and they're actually packaging electrons, i.e. electricity. So they're using energy from solar farms and digitizing it, and in creating investment, which they claim can be as much as 12 or 14% per annum. Now, to me, that sounds quite attractive investment, ESG friendly. It normally, there's lots of sunshine in Australia. Currently, certainly Sydney, had lots of rain as opposed to sunshine. So I would caution, and I wouldn't say it's going to be bad for everyone, but for me, the whole situation it's like the emperor has no clothes on, and we're all saying, isn't it terrible? Isn't it bad? And but let's gear up, and on our credit card or on our mortgage. And governments have been the biggest bingers of credit, and they're not accountable. There is no accountability for government, and I think I've been involved in managing people's money, having run an asset management business since the late 80s. And the complacency now reminds me of Lloyd's of London. I can remember clients saying, oh, I'm thinking of becoming a name at Lloyd's of London. And what do you think? I say, what? So you want basically exposed to unlimited liability. And that's what it was. And literally, I can remember, not particularly sophisticated people trying to get into Lloyd's and placing their house as margin because they didn't understand what they got involved in. And I think one of the biggest financial scandals right now in the UK is the fact that a so-called low risk asset allocation is to have your money in fixed interest. And we all accept inflation is going up before what's happened with Russia and Ukraine. And yet we're putting money into an investment, which as interest rates go up, bond prices can only go down.
So by fixed interest, you mean bonds, loans to government and loans
bonds,
to big companies,
absolutely.
But particularly loans to government. And this is something I'm coming to you in a minute, Adrian, but Tim, this is essentially what you're saying about the bond market, which is way, way bigger than the stock market, but it's a massive, great bubble of hot air, it sounds.
Yeah, I mean, the issue is that we've had a 40+ year bull market in interest rates and bonds, and that is probably the main reason why the stock market has behaved the way it has over the last 40 years or so. So now both markets have gone down in tandem. Firstly, nobody with any practical investment experience, with the exception of Warren Buffett and Charlie Munger at Berkshire Hathaway, and they're in their 90s, with those two honourable exceptions, nobody alive has seen a bear market in bonds. We'll strap yourself in because you're going to see one now. The other question is whether, and I think the answer is yes, whether a bond bear market is going to have to bring down the stock market too. And I think particularly in the context of growth stocks, which is, I mean, I'm talking my book here because we're clearly value investors. To, the clues in the title of the firm. But I think that if in the event that the bond market really gets into difficulty, which I think it already is manifesting signs of, that is going to impair prospects for the growthier parts of the stock market too.
And Adrian, what do you think about the bond market? Because I mean, every time I talk to Tim or pretty much anybody else who knows about the bond market, it sounds like it's in a bad way, and yet pretty much everybody's pension fund is invested in that. So this is really bad news for pensions, surely, among other things.
Well, at least in part, yes. I mean, I'm not a bond market expert. There was the brief inversion earlier this week between the 2-year and the 10-year, which obviously a lot of the media jumped on as a traditional harbinger of recession. The 3-month to the 10-year yield curve points to something different. That's been widening and steepening. So there are contradictory signals there, which maybe Tim and Johnny can explain better than I can. But for the general punter who's wondering, are we set for recession? The signals from the bond market are not yet totally clear. The inversion anyway was extremely narrow and very brief. It's been the case for a while. It's been the case for the last couple of years, hasn't it? That the old 60-40 portfolio idea is under attack. It's kind of no good anymore. And when I was a journalist, and also now at Tony and BestInvest, we've been arguing that there are other diversifying assets and there are other stabilizing assets that will do a better job, hopefully.
Sicky.
Oh. Yes, we'll do a better job of setting aside equities in a portfolio. We'll get onto that later, I'm sure, whether it's gold or infrastructure or whatever it is. But yeah.
And speaking of the portfolio, what do you think is going to? I mean, $65 million question. What do you think is going to happen to the stock market in the next, say, 12 months? Because I've been saying for years, it's about to crash. It's about to crash. It's about to crash. It's still
no, indeed, Jasmine. I mean, if you told me at Christmas 2019 that over the next nearly 2.5 years there's going to be a global pandemic that shuts down large parts of the economy for months on end and keeps people in their homes, and then after 2 years, when that eventually looks like it's coming to an end, that Russia's going to invade Ukraine and potentially cause a world war, you would have thought the stock market would be considerably lower than it was at Christmas 19, but it's not. It's the same. Well, the FTSE anyway, and it is still around 7,500, which is pretty much where it was in Christmas 2019, and S&P 500 is significantly higher. Obviously, there are reasons for that.
Well,
not these quantitative easing. So, is this all building up to a big crash now? Everybody's been waiting for the taper tantrum. Why hasn't it emerged already? There's money that's got to go somewhere, and there aren't many options apart from equities at the moment.
Well, exactly. Cameron, I mean, one thing that I'm constantly talking about on TV and radio in relation to inflation particularly is the astounding amount of quantitative easing that has been happening, particularly in the last 2 years, but really since 2008. In other words, money printing. So this, as you said, is devaluing the currency. And now Bank of England is saying it's it's stopping it. The Fed is stopping it. Do you think that they really will, or are they going to actually go, no, I think things are too bad, we need to print some more money and devalue the currency even more?
Well, inflation also occurs due to the velocity of the money in circulation as well. And it's not all on the central banks. I mean, the central banks can't move interest rates enough to change the appetite for credit beyond the fact that everybody's up to their eyeballs in credit type of thing. Because actually the money creation comes from the writing of loans from the banks. And if, and if interest rates are, once they go below sort of, I think it's about 3% actually, people kind of borrow as much as they were going to borrow. They're not that motivated by the fact that it goes down by another % or something. And what we're seeing, like with the Bank of England's a good example at the moment, inflation's going up close to 1% a month, and they're adjusting, adding interest rates at 0.25%. Central banks really can't raise interest rates very rapidly because they're going to put banks into bankruptcy. They're going to put countries into bankruptcy, into default positions. And inflation in any event is still, it depends how it goes, but inflation anyway, it comes from the velocity of the money in the system as well. So I think I liked what Johnny was saying, a comment he said about it's not going to be bad for everyone, like what's coming. And it's absolutely true. And what's important for us as individuals, we need to get on the right side of this. Being, I don't know what the cliche is, but being prepared is, being armed or something. One thing, I guess, when the global financial crisis happened, what was kind of became apparent that the people we trust with the money that we use every day aren't necessarily that clever, or so maybe they're incompetent, or they're not necessarily trustworthy. And to Tim's point, they've actually, as a policy agenda item, looked to devalue our hard-earned income. We in society should have a right to earn money and then put it somewhere where it's convenient to use as money without having to think in terms of investments, and it should be able to hold its value, and we should get full utility of it. That's really the premise of Tally, actually. I know we use gold as the anchor, but that's to give it accountability to something and to give it an easy way to people understand how it derives its value, which is one of the shortfalls you have with cryptos and people that achieving mainstream adoption.
Actually, can you explain about that, the Tally? Because one of the things that I found interesting about your product is that when you put money in, it's immediately converted into gold, and gold is keeping up with inflation better. But obviously,
no, it does. Just as an example, I think the pound and all the major fiat currencies have devalued by 90% over the last 20 years against gold. And in fact, the pound has halved in value in the last 5 years against gold. And the inflation we look at the moment, it's surprising in a way, because I was just discussing this earlier. We're at 6% or whatever in the UK now. And if you have a look from where it was 12 months ago, you'd go, well, it was whatever, 2% or something. But it was 1.5%, 2% for the last 3 years. In the last 6 months, it's gone from there to 6%. So what the problem with inflation is, it moves exponentially. Once kind of the genie's out of the bottle, you can't put it back in. As I think Tim was describing, inflation is a wonderful way for governments to, inflate away their debt obligations. But that value, that wealth comes from someone. Like, somebody has to pay for that, and it's us. It's the public. And this is, again, with Tally, it's got some very simple principles to it. Yes, we use gold, and the price per unit of Tally, or every unit of Tally, is a milligram of gold that belongs to you as the customer. It's one thing you want to get away with if you are thinking in terms of an investment or money that you hold. You want to get rid of counterparty risk as much as possible, which is, it almost sounds like a conspiracy theorist, but it's a real thing. But most people don't really worry too much about counterparty risk. But you really want to own, whether they're commodities, whether it's gold particularly, whether it's some other, whether it's equities, or even just ownership of a company. You really want to be have the direct ownership as much as you can, without any layers of or any layers of a contract to the degree that you can. You need some contract in place, but or any layers that dilute your direct ownership of something. So you might get exposed to the price, but when the crunch comes, you will find it is a bit of whoever was saying, like the emperor's clothes.
That's a good point. Actually, as you're talking, I'm thinking somebody else, another friend of ours, Gordon Kerr, has told me that banks in this country are 97% leveraged. I'm talking high street banks. I mean, I don't know. I haven't read that, but in other words, we think that they've got our money. You think when you deposit money with a bank that's it, it's there. But actually, when you deposit money with a bank, a high street bank, they go, thanks, we'll have that, and we'll lend it out elsewhere. So if all of us went to the bank and said, I'll have my money, thanks, they go, sorry, no, it's out there.
Well, it's not just that.
Jasmine,
Jasmine,
sorry, yeah, Johnny.
Oh, sorry.
Yeah, can I come in on that, because I think that's quite an interesting idea or topic for people to consider. First of all, I'm not an expert when it comes to crypto, simply because crypto itself hasn't been around long enough, and there are no experts. And actually, cryptos per se are a rounding error. Yes, you should maybe have 1 or 2% invested in it because it's a different asset class. But the concept that you're going to see Bitcoin, which is the biggest and well-known crypto, replace a medium of exchange is, I think you're just singing from cuckoo land, to be honest with you, because there's just simply not enough of it, and the volatility and the lack of liquidity is something. But what I wanted to come in there is, if I said to you, and you're a wealthy individual or a company, and you've got, let's just call it £1 million, €1 million, $1 million, okay, a reasonable sum of money, and I said I can improve your ESG credentials, i.e. your environmental and social corporate governance credentials, with your cash, and I can reduce the risk. Most people say, yeah, tell me a little bit more, please. So let's say that I'm investing, I'm depositing my money with HSBC or Barclays or NatWest, it doesn't matter who it is. And instead of actually depositing money with a bank, where the bank then goes out and lends the money, and I have no idea who it's lending the money to. So therefore, I have no idea what my cash is doing to fuel perhaps projects that I'm uncomfortable with for whatever reason. Alternatively, at the same time, I'm exposed to the risk of the bank. And if one of those banks goes bust, then I've lost my money. So don't tell me they're not going to go broke, because the amount of debt they're holding and the fragile nature of our existing systems. We saw Shearson's go broke. I'm not sure whether the government's going to stand behind the banks next time. So why take that risk? So what I would suggest you do is take the money out of HSBC, out of their deposit account, bundle it up and put it into a nice bag, and go back to HSBC and say, hey, HSBC, we would like you to carry out treasury management. We would like you to manage our money in accordance with these criteria of only investing in high quality ESG compliant type opportunities in cash still, which is freely available. So you've now got control. You're not actually putting it in deposit. They're simply doing treasury management. So you've reduced the risk of what happens to the bank, and you've improved your ESG credentials. And you do that all by creating effectively a digital version, a stable coin. It's something backed by cash. Now, whether you are an individual, you are, Apple or Amazon or PwC or IBM, you can effectively create your own digital wrapped cash. The problem is that HSBC, instead of earning 3 or 4% per annum, are now earning 0.3, 0.5% per annum. And you've removed that £1 million from the liquidity. And as I think it was Tim was talking about, inflation is very much about the velocity of money. Banks then can't endorse fractional banking, they can't lend that money. And so the system starts to slow down. And this is why it's very, very unlikely we will see a central bank digital currency where you can deposit your money straight with the central bank, because why on earth would you leave your money with the commercial banks when you've got a guarantee of a country and a government as opposed to a commercial entity? So I think we just need to be sort of very mindful of how these things can work. And that's where I see some of the opportunities. You can actually have lower risk and improve your ESG credentials very, very simply, very, very easily.
Yeah, I mean,
sorry, Karen.
So the fundamental problem with that, though, Johnny, is that you're anchoring the value of your money to an asset that is devalued by design.
But you're reducing the risk of how you're currently holding your money. Now whether
Sorry,
holding
the counterparty
money
risk,
or not,
you mean?
I'm talking about the risk of you don't know where the bank is lending the money out to.
Yeah.
ESG is really, really important for staff, shareholders, and a wider audience. And most people play lip service to it. But it is becoming more and more people saying, I'm not going to invest in your company unless you can prove your ESG credentials. I'm not going to approve you as a supplier unless you can prove your ESG credentials. And all these are incremental parts. But what I'm saying now, we have the technology, and the reason crypto is so important is nothing to do with the cryptocurrencies, but it's the technology and what you can do with the technology and how you can actually create more trust because you have more transparency.
But then, as you say, the issue, because I'm a fan of crypto. I have some, but I am very concerned about the idea of central bank digital currency because of the knowledge and the control that it involves of the central bank. The great thing about crypto is that it's decentralized in a kind of theoretical way. You're sticking it to the man. But, if you have, as we've had, we've got a question here from Rebecca saying, what are your thoughts on digital currency suggested pushed by the government, the levels of control, yes, she says, they will have, etc. I find this pretty terrifying. So you're saying that it's not a problem, Johnny, is that right? But do you think that it would be okay that the government wouldn't have control? Because I can't see a situation where they wouldn't have too much control and over our money.
The reason we will have central bank digital currencies is because it gives the government another tool. It gives them another way to manipulate economies for the good or not. So it's coming. And look, when the whole thing
that's a bit like saying that we'll end up with gas chambers because government can control us all more easily that way.
No, it's nothing like that. It's nothing like that. What you've got, look, digital currencies, cryptocurrencies came about because people wanted to get around the banking system after 2008. They didn't trust it. They were looking for an alternative. So if you like, the crypto punks were like this, and governments and organizations, like the whole thing's gone on its head, and you're now seeing the agenda being driven by governments and large organizations because they've realized the world economy, 15% of the world economy, every single person on this call at the moment are part of the shadow economy, the informal economy. All of you are fueling the informal economy because when you go to a restaurant or a pub and say that's fantastic service, there's a tip. Or whether you have your car cleaned or your house decorated or whatever, you're all part of it. And the governments don't like that. In France, it's illegal to spend more than €1,000 in cash. Illegal.
Well, exactly. But I don't think, I think that's exactly what governments want, but that it's not a good thing. I mean, I think we understand that people need to pay tax, etc. But at the price of personal freedoms, that I would say is an issue there. Tim, I know you have some views on central bank digital currencies and what they could potentially mean.
I mean, if my take on this is that if central bank digital currencies are allowed, it's the end of financial freedom for everybody. So it cannot be allowed to happen. I don't dispute that we're in a new digital realm, et cetera, et cetera, et cetera, and I have no problem with that. Where I'm coming from is, I resent big government already. I would move heaven and earth to prevent CBDCs being introduced. And I'm not sure that governments yet have sufficient popular support. I think one of the things that's sort of in the background is one of the sort of tectonic plates that's shifting as we speak. There is going to be monetary regime change. The monetary system that was introduced in the early 70s, basically Nixon taking the dollar off gold, and then the introduction of the petrodollar. These are all dying concepts now. So I'd argue that probably the most important thing that's happened this year is the US administration under Biden completely shooting itself in the foot by freezing Russian foreign exchange reserves. This is something that didn't even happen in the Second World War. The Bank for International Settlements, the central bank, always acknowledged and kept inviolate, even Nazi money. But the US is arbitrarily just driven a coach and horses through that system. I think as a result, I mean, I would describe it as the Biden administration in its relations with Russia is now like a clown running through a minefield. It has no idea what it's doing. Coming up in response to what Johnny was talking about in relation to CBDC and everything else, I think it's wishful thinking on my part, so I don't know how realistic it is, but it seems to me there's a very real possibility that firstly, commercial banks, as we know them, will cease to exist within the next 5 to 10 years. And I very much hope that central banks, as we know and understand them, also cease to exist to get replaced by something better for the people of the world.
And I'm thinking, Cameron, as Johnny says, and other people have said, central bank digital currencies are happening. They're already happening. They're here. Cope with it, deal with it. Do you think there is an alternative? Are we all just going to have to go, okay, fine, you control my money, whatever?
Yeah, well, it's not just controlling the value of your money, it's controlling the access to your money, and it's controlling your privacy. It's one of the beauties of cash is you could go down the road and buy a drink or something. Nobody's electronically following you. So there's lots of problems with CBDCs. I agree with Tim that it's a terrible idea. I don't think it's, I think governments will try to go there. I don't think that they'll necessarily get the traction they want. So using blockchain for more direct frictionless payments, I can see that technology coming in instead of something like SWIFT. I mean, that makes sense. But, governments create digital money already. I mean, there's only 4% of the pounds and, the money in created in the UK, only 4% is printed or minted. 96% of it is digitally created. So, they're already in digital money. If we give them something like an immutable, decentralized ledger like a blockchain, then it's like time stamped in there forever. I almost, I say this facetiously, but I feel sorry for the Canadian Prime Minister Justin Trudeau, because he had to round up all the banks to shut off access to money for all the protesters that disagreed with his politics. Now, if they just had Canadian CBDCs, he could have just done it directly himself.
Yeah, that is kind of the issue, isn't it? Adrian,
Jasmine, one of the problems that I think that we are staggering along and not acknowledging is the inevitable decline of the US dollar. And Tim he said, about a clan going through a minefield. And we just have to bear in mind that over the last nearly 600 years, on average, the central bank currency of the world has only lasted for about 94 years. The US dollar has been around for just over 102 years now. Prior to that, it was the French franc. Prior to that, it was the Dutch guilder. Prior to that, it was the Spanish peseta. Prior to that, it was the Portuguese real. And most of those other currencies have basically fallen by the wayside due to physical war. I would suggest that what we're in the process of seeing is an economic war, and the US economy has become so bloated and as Tim quite accurately says, has become so undervalued because people are losing confidence with it. Now, whether we're going to go and see the Chinese digital currency, which is, they've already launched it, so a central bank digital currency, they've got nearly 30% of the population have already got digital wallets and are using it. They know exactly what's being spent, where and how. I'm not sure that will replace the world reserve currency, but maybe we are going to go back to some form of alternative.
Well, it might be a multipolar currency world. So instead of the dollar, you have the renminbi, you have the yen, you have the euro, you have sterling for what it's worth in Swissy. But the King dollar is no longer prominent, no longer dominant in that realm.
Or it might be backed by something like property, because at the moment, fiat cash that you introduced at the beginning, it's only a $40 trillion asset class. If you look at the value of real estate, that's actually a $326 trillion asset class. So if it was technically possible for me to literally go and buy a coffee by taking the brick off the top of my chimney, and I could then use my house as my bank, it would be arguably harder for governments to manipulate the global real estate market. And effectively, you could have a debit card linked to your house. So I'm just saying there's some huge opportunities that technology is allowing, that we can actually start thinking of things in a very, very different way and not be necessarily restricted and limited to just, oh, equities, bonds, and real estate.
Now we've had an interesting comment from David Wetton here, who points to the connection with the 1940s, where we had low interest rates, high debt, and high inflation. Yeah, very similar, I think. And of course, it was 1944 that we had the dollar coming in as the international standard. We talked about that, so he suggests, are we having a shift towards China, talk of China, Russia together, coming together? I mean, similar to what you're saying, Tim, there's, multipolar. Both, and he says, both have significant gold reserves. So could it be a gold-backed standard? I mean, and this is what a lot of people are talking about, particularly as, the ruble is so strongly backed by gold. And it was quite interesting when the ruble lost some value, that meant that the amount that it was backed by gold actually increased, the percentage, which is very interesting. So I wonder if we are coming to a point where, yeah, we could be having some sort of multipolar reserve currency ultimately backed by gold. I mean, I'm guessing that would be your ideal, Cameron.
Yeah, sort of. I mean, that's what Tally is. I mean, you have direct ownership of an asset, a commodity that sits somewhere, and then you can utilize the value of that through familiar banking rails and, infrastructure and point of sales, and, using a MasterCard, debit card, all this kind of stuff, ATMs and UK faster payments, all this stuff that we're familiar with, but you're actually using money that represents a completely different asset. It's not debt-based the way fiat currency is, and it's not being devalued by design the way fiat currency is. Governments, so there's two things. Governments invariably debase their currency. So there's a reason why we don't have a gold standard now. It's because the US issued too much currency that they didn't have the gold for. And so when people started coming in asking for the gold in 71, Nixon said, well, we're going to close that gold window. And then that was the last of any major currencies being anchored to something. I mean, gold, I'm not a gold guy. It's just that historically and everywhere in the world, people understand what it is. They understand it's valuable. Throughout civilized history, it has been the right anchor for a monetary system. Gold on its own is not money, because money is also a medium of exchange and a unit of account, and gold on its own doesn't deliver that. So, and this is why I designed Tally, because I was actually back in 2014, 15, heavily into the blockchain industry, particularly when Bitcoin was really the only iteration the world had seen as a useful application of blockchain. And in fact, went on to our company that I co-founded, became the world's first blockchain industry company to successfully IPO. So we listed that in London in Christmas Eve 2015. And it was through that I actually got deep learnings around Bitcoin and why that even existed. That didn't come out of just the financial crisis. I mean, the problem that led to the financial crisis, these structural problems with fiat currency and a credit creation-based monetary system, smarter minds than mine have been aware of this for a long time. And so Bitcoin, to kind of, if you do a deep dive into the concept of money and say something like Bitcoin, how that comes about, you have a look at what came before Bitcoin and why actually Bitcoin has succeeded. And in my view, even back then, why Bitcoin won't be able to achieve mass adoption is for some very fundamental reasons, which is why I designed Tally to address those things. One of them was to make it very simple to understand how it derives its value. So, and gold, again, is just the easiest thing to get. I like the idea of real estate, but you've got a whole host of different problems there, and you get, there's a whole technical layer that there's a lot to think about there. Anyway, but I like
it is an interesting
thought about it.
Yeah, it is.
There's a lot to go on that.
As Johnny points out, it's a huge market, particularly compared to actual currency and gold.
Yeah, but I mean, even so, to that point though, gold's got about a 10 trillion US dollar equivalent value, I think, at the moment. That's not to say it couldn't be the global money. It's just a mechanism of price. The price per ounce or per gram, however you want to measure it, would be at a multiple of where it is now, and there'd be plenty of it. With Bitcoin too, that money supply is 100 trillion units of currency there. It's 100 trillion. There's no shortage of units of currency you could use for that, because they go to 8 decimal places. So yeah, it's 21 million Bitcoin, but they go, anyway. So yeah, I mean, governments could go back to a gold standard. First of all, when they came off the gold standard in 71, the US dollar was only 40% backed by it. And again, you're relying on this counterparty not to kind of, frankly, screw you over as the population, because of the system that it operates in. So I think you've got to be, this is the other thing too about cryptos, and I'm a massive fan of Bitcoin. And again, I got most of my deep learnings around currency were inspired by Bitcoin and all this. But we need solutions now. We're facing problems now. And people, I think are kind of alive to the fact that they can't rely on the state to protect them. And in fact, sometimes the state harms them.
Yeah.
And
we do seem to be at that stage, where we've seen the state harm us. Adrian, you've been very patiently sitting there. What you've written about this and about sort of investing in particular for some time. What are your views on how we as individuals, as consumers, can navigate our way around this? Because we're talking big things here, big global issues.
I was keeping quiet because crypto really isn't my thing, so I thought I'd let the experts, deal with that. Yeah, look, I mean, just to put my cards on the table and to maybe roll back a bit, I don't think inflation is the threat, the long-term threat that some of the other panelists do. If you want my bet, I think in a year's time, it'll be back down to 2%. It's an annual comparison, sort of. If things go in Ukraine as one would hope they do, that there is some sort of settlement, that the difficulties in energy supply and energy deals are ironed out. I don't see inflation being a long-term threat. Excuse me, sorry, just turn my mobile off.
that's inflation calling.
Yeah. One fear is that rising bond yields will start to unnerve the equity market, and there is a higher risk of volatility and a higher risk of a major correction in the equity market. For the personal investor, though, for the private investor, it's a long-term game. If you've got an ISA or a self-invested personal pension or a workplace pension, you can't start reacting to short-term market movements. And this is a situation that, most people with large amounts of savings and investments in this country are in. It's not, it's not in crypto. It will be largely in equities. There are steps you can take, certainly, to try to stabilize a portfolio and help to protect it against a big correction. And it helps to have that insurance in place before the accident happens. The problem is a lot of the time, it's like diving to gold down. Well, gold's already, how much of market volatility and inflation, etc., is priced into gold already? Are you getting in there too late? Certainly index-linked bonds, for instance, are probably too late to get in there for any inflation protection. So you've got to be a bit more imaginative, maybe look at infrastructure, some of the renewable energy investment trusts, maybe they're on a premium, unfortunately.
You mentioned infrastructure. Can you explain that?
Well, I mean, it earns an income. So that in itself is a protection against, if your income is protected, if the income from an investment is roughly equal to inflation, then capital gain is all gain. Your gain's not being eroded. So
you mean funds that invest in roads, rails, waterways, that sort of thing? Yes, for sure. Yes, because they have long-term income streams. What about commodities and commodity funds? Surely those do well.
I mean, again, it's a case of has the horse bolted? So there was already at the start of last year, we were at the start of a commodities, or what many people thought was the start of a commodities super cycle, because we were emerging, as we thought anyway, from lockdowns. There was this, huge restart of the global economy. And sure enough, if you'd bought into something like the BlackRock Mining or Energy and Resources Investment Trust back in January of last year, you'd be looking at huge gains now, because that super cycle, if that's what it turns out to be, has only been turbocharged by the Ukraine war. The problem is now is what you've got to look forward. So, if there's a settlement, and let's hope there is, in Ukraine, if things settle down, then we're not going to have the energy crisis that sort of people like writing headlines about. If anything, we could be, at the peak now. It could all be down, in terms of energy prices, on the wholesale market anyway. It could be
on its way
seeing
down.
The worst. We're seeing the worst.
Jasmine, tonight you wanted to talk about, are we about to face a global financial crisis? And I just to focus on that, I accept what you're saying, Adrian. The trouble is you're talking about a backdrop of nearly a 12-year bull market in cycles, in equity prices. And the one thing that history teaches us, that things change, nothing goes on forever. And we've seen equity markets perform extraordinarily well. And what is almost guaranteed is there will be a reversion to mean. We will have a pullback. Things don't always stay the same. And whether it's inflation or whether it's commodity prices carry on going, we had a baked-in inflation problem more than 6 weeks ago. All we're seeing is what's happened in Russia and Ukraine is that the emperor's got no clothes on. This is not sustainable, that 70% of the active ingredients in pharmaceuticals, paracetamol, things like that we consume, come from one country. The whole global supply chains have been reliant on just exporting jobs and importing people's, and in a very deflationary environment. And that's what's happened with globalization. And people are saying, no, I think we actually are going to have a slight change in the way we purchase and what we do with things. And that's healthy. There's nothing wrong with that. And there will be some great opportunities, but the day-to-day saying, oh, don't worry, put your money in equities, or a low risk investment is fixed interest. I think we're deluding ourselves. Things are changing, things are moving, and that's being helped by technology, and it's being helped by awareness. And that's a really positive thing. But just doing the same is a very dangerous investment strategy. Just
on the topic of commodities, the constant commodities index versus the S&P 500, the broad US stock market, that ratio has never been cheaper in favor of commodities for 60 years. This commodity bull run has only just started.
And you're saying about the commodity bull run. What about inflation, Tim? Do you agree with Adrian that it could be short term, or do you feel that quantitative easing has some time to get out the system?
Well, the central banks have boxed themselves into the mother of all corners. They can't cut rates anymore because there's already high inflation. They're already delinquent in their main task of trying to keep a lid on the stuff. And they can't raise rates either because they'll crash the stock market and the property market. So good luck being Jay Powell or Andrew Bailey or any of these other morons.
Unless they do more helicopter economics, unless they give money away via some form of digital currency to those people they perceive need it.
But
put it past them.
Very briefly, the single biggest learning experience I had in my career, arguably, was September 92, which is when sterling was ethnically cleansed from the ERM. And what that showed me was that, central banks and governments can kick around the stock market to a greater or lesser extent, and they can even kick around the bond market. The one market that's too big, even for central banks to control, is the currency market, because it's too deep and it's too liquid. What I suspect is going to happen is that they'll try and keep a lid on market interest rates, the yields in the bond curve, and in doing so, the speculative / trading community will respond to that by basically taking out the currencies of those operators. In other words, all roads lead back to gold, because the one currency you want to own is the one currency that can't be printed, and that's gold.
So do you think, Tim, that gold is underpriced? Because it seems, given that so many countries are buying it up at the
Well,
moment.
let me answer the question in a slightly different way. The issue is not what gold is worth in dollars or sterling or euros or yen. The question is, what is the dollar worth? And I think it was Voltaire that said that all fiat currencies ultimately decline to their intrinsic value, which is zero. So I think we're going to see the death of the dollar in our lifetimes.
Interesting. And
if I could just come in there, Jasmine, there's lots of stuff talks about gold. It's a hedge against inflation. It's something that you want when the dollar's weakening. It's a hedge against uncertainty and volatility. The one correlation that has always stuck with gold is that it's inversely related to real interest rates, and specifically real 10-year US Treasuries.
But I don't see how you can trust. I don't see how you can trust bond prices and bond yields, because they're being manipulated along with everything else. So the bond market, I would argue, is uninvestable. And
it's been manipulated now, but it wasn't in the past.
No, for sure. But as I think it was Johnny was just saying, things change. Environments change. All I'm saying is I put more trust in a form of money that's been money good for 5,000 years than I do with any of the morons trying to run central banking policy at the moment.
I don't buy the idea that inflation is something that is purposely, sort of manufactured by authorities to inflate away debt.
Who controls monetary policy?
I think it's convenient. It's convenient for them, for sure. It's convenient, but it's not a policy.
You think it's accidental?
We're not going to agree. We're not going to agree on this one, I'm afraid.
Well, I'll go to give Cameron the final word here. Cameron, what do you think?
The topic I think, as Tim was just saying about the apocalypse of the financial system, all this, and just with what Johnny was saying about the history of money and global currencies and all this type of thing. Look, it is cyclical. They're big cycles. I think pretty much all of us on this call have grown up where the Cold War was still going on, where the US dollar has been the global currency. Change is a bit unsettling, but it's always happening. And we are going through a period of change in the next 2 decades that are nothing like what certainly the last 2 decades have been interesting, but the last 40 years, like the next 40, there's going to be significant change. But again, if you just use your common sense and make sure that you're not relying on too many others, and that you're being robust and resilient, not getting yourself too heavily indebted, making sure you can get hold of some assets that you understand and that you directly own. In the case of what we do at Tally, it's convenient because it's money, and everybody needs money. So that's the answer to that. And I'm not surprised the private sector has to come up with the solution, because central banks and governments aren't motivated to do so. It's not where they leverage all their benefits from. But I just say it seems like an apocalypse, but it's just change, and we'll all be okay.
If we keep on, I'm going to give you another word, Johnny, because as we said, things are changing. So do you think that we can trust the machine? Can we trust technology to create something to help us, or is it just going to create another monster, do you think?
Well, so Jasmine, we as you know, we have a weekly publication called Digital Bytes, which looks at how, where and why blockchain technology and digital assets and some of these macroeconomic things, how does it impact on you, your business, on society? And we have a whole load of examples that we give every single week showing, what you can do and how you can actually be aware of some of the things that are going on, with sort of real case studies from various different publications. And I totally agree with Cameron. It's an opportunity. There are some really interesting changes. Unfortunately, 99% of the people, or probably most, let's say the majority of people on this call, have no direct exposure to any form of FX management. If we were talking to super wealthy investors, that's where they have their money. But we don't invest in foreign exchange.
Foreign currency.
Foreign exchange, currency management. We just don't do it because it's a very very involatile investment. Most people have very little exposure directly to commodities. Most people have far too much exposure to property. And therefore, just take a step back from your portfolio and look at where you're invested. If you were 100% in cash today, would you then go and make the same investments that you have now? And having spent nearly 40 years in financial markets, I can almost guarantee you would not do the same as you currently have. So take stock and say, well, maybe I do have a little bit in these funny crypto things. Maybe I do have a bit in that old-fashioned thing called gold. Arguably, silver is much, much cheaper. So maybe put some money in silver. But I think that people are very lazy and they don't actually go and look at their investments. And I think that we do have an endemic problem with far too much debt. And it was leading to higher inflation before the Ukraine thing. The Ukraine thing is has just compounded it. So just keep it very simple. Keep it really simple and take advantage of some really, really interesting opportunities out there rather than getting freaked out and worried. And don't be surprised if we do see interest rates go up further. And don't be surprised if the equity markets fall, because that's a healthy thing. That helps to correct the excesses that have been built up over the last, arguably, 10, 15 years.
Interesting. Well, that's a good positive note on which to end. And can I just remind everybody, this is not financial advice. Nothing that has been said today should be taken as financial advice. As they all say, you do your own research, make up your own mind. And if you'd like to get in touch with anybody who's spoken today, I'm sure they'd be happy to hear from you. That is Tim Price, co-founder of the fund managers Price Value Partners, and Tim has put in the chat, I think, a link to his book, or you can certainly get in touch with him at Price Value Partners. You can get a PDF copy of his book. Cameron Parry, founder of Tally Money. Again, have a look up Tally Money to see what that's about. You can open up an account with them. Johnny Fry, former fund manager and more recently founder of Team Blockchain. And as Johnny mentions, they have a newsletter every week with lots of information about DeFi and blockchain and crypto related products. And finally, Adrian Lowery from BestInvest. BestInvest is a platform, an investment platform that you can join to manage your own investments. So these guys, thank you very, very much for being here. It's been really, really interesting to hear you. Now, this is being recorded. It will be uploaded to MoneyMagpie.com. It'll be in our newsletter. It'll be in our Tuesday newsletter. It'll be in our investing newsletter, which goes out every other Saturday. Sign up to both of those. You know you want to. It's been lovely to have you here. Do feel free to email me about anything. If you want to email MoneyMagpie about anything you've heard tonight, or anything in the world generally, editorial@moneymagpie.com. We always answer. Lovely to have you. Thank you very much to everybody for being on this call.